Okay, next stop is a banker, an ex-banker I suppose. We're deep in the heart of the Constantia winelands. Actually we've got Klein Constantia up there on the right hand side. And we're here to get his views, probably a little bit more on a household debt this time. It's Tom Boardman, the ex-CEO of Nedbank.
Access to finance is an essential ingredient for most people, for most businesses, and in fact for most growing countries. So the problem with debt is that there are times that you need it, and if your debt levels are such that you can afford the repayments, then debt can be a very positive instrument. However, if you borrow too much, then debt becomes a very negative instrument. There are very, very few people in the world who will ever be able to own their own home without getting a home loan, without borrowing. There are very few people even who will be able to buy a car without getting some kind of finance. Lots of people need help and funding if they want to put their children through university. So access to finance for individuals is very, very important. And it is for business.
There is nothing fundamentally wrong with debt, because it makes sense for people to borrow, because essentially you can buy real goods and services today. I mean, there's a wonderful phrase when credit cards first came out. One of the marketing slogans that was used was credit cards take the waiting out of wanting. So, and a credit card is just a borrowing instrument. So this is actually crucial that we can actually borrow and spend the money today. But implicit in that is some propositions. One is that we have the capacity to pay it back, which might be that we actually, if I'm a business, take that money, invest in something which produces income, which can be used to pay back the debt, or I buy an asset, which could be shares or a house, and I could sell it later, and it's sufficient to pay back that debt together with the interest.
It's like good cholesterol and bad cholesterol. There's debt that you incur for consumption purposes, which is effectively bringing future economic activity to the present. And there's debt that you incur for investment purposes, which has its own self-sustaining underpin to it. The problem is it is much easier as individuals to get debt or credit for consumption purposes than it is to get it for investment purposes.
When I wanted to start my Boardman stores, and I went to the banks to try and borrow money to buy the 2 hardware stores that I used as the base to start Boardman's, the banks wouldn't lend me any money against the stores. They said, no, we want some solid collateral. And they said, have you got a house? And I said, yes. And they came and they valued the house. And they said, well, there's equity in the house. The house is now worth more than your loan. So we'll take a second mortgage on your house, and we'll take possession of your stocks and your debtors, and you've got to mortgage your wife and your children. But what we really want is the house. And it was the fact that I owned a house that had equity in it which enabled me to borrow money to start my business.
We're here at the head office of Anglo Gold Ashanti, which is South Africa's biggest gold mining company. But we're not here to talk gold, we're here to talk debt. We're here to talk to the chairman. You may know him as Tito Mboweni. Let's go and see him. It seems to me that we've lost that basic principle of borrowing. I mean, we seem to have forgotten about the fundamentals. If you're going to lend to someone, you be confident that that person can pay it back, and it just seems that the system has got out of control.
We've seen the ratio of household debt to household income rising. And the interesting thing is that this has been rising even as interest rates were coming down. That tells you a story, that households have a tendency not to rush to repay their debt when interest rates come down. But what do? They pile on more debt because they think interest rates are too low, they can afford to repay, forgetting that the interest rate cycle can always change in one direction or the other.
When I was running Nedbank, many times I said to our staff, I said, we have to remember that banks are unique institutions. Banks touch everybody's lives. And we actually have the ability to make people's dreams come true. We have the ability to make it possible for somebody to own their own home, to own a car, to educate their children. But the gap, as we know from the nights, the gap between dreams and nightmares is a very thin line. And if we lend people too much money, it's going to turn into a nightmare. And so we have a responsibility as a bank to ensure that we stay on the dream side and we don't slip over into the nightmare side. And I think what we are seeing, and we've seen it around the world, average household debt levels increased steadily from the 50s and 60s. Then we had that wave where right around the world we started getting inflation under control and interest rates dropped. And household debt in South Africa went up and peaked at about 80%. Went from 50% to 80%. And I have to tell you, in Australia, in the United Kingdom, America, it went up to 130, 140%. Now the reason they went much higher is the interest rates were much lower. I think interest rates were too low for too long. They tried to create eternal summer by keeping interest rates too low. And every time interest rates wanted to push up, they found a way to push them down. A bit like quantitative easing at the moment. And I'm not sure that using the thing that caused the problem is the remedy to the problems that the world is now facing.
As you start to push out and start to get more and more debt, you start to lend to more and more marginal customers. And so under those circumstances, what we've now got is this huge debt problem in a lot of countries at the individual or at the consumer level. And to some extent, that is a huge problem at one level, but it's also a problem at a subtler level, because what actually happened was real incomes, that is, people's wages and salaries did not keep up with inflation. And now, of course, we've got the twin problems. One, we actually have debt which many of these people will never be able to pay back, with a huge impact on consumption going forward. And then on the other side, we have the social inequalities of a lack of growth also being exposed. So it's a huge issue for us going forward.
I'm very pleased that there's a National Credit Act that should help by forcing the lender to be satisfied that the borrower has the ability to repay. I think that's a good intervention. That kind of intervention you don't have in many countries around the world. So we were amongst the first to do that. And it's helped quite a bit, except that some households, particularly those earning 7,000 rand and less a month, have tended to bypass the banking system, the official system, and gone to the mashonisas, the private lenders who are not regulated. And therein lies the problem. In the township, people don't go to a bank for micro lending or micro borrowing. They do so with the mashonisa, the fellow who lives next door, who for every 2,000 rand that you borrow from him or her, the interest rates will probably be something like 300%. Look, at the end of the day, the issue of debt has to do with how countries or individuals balance between income and expenditure and the sustainability of whatever borrowings you need to do for the future.
I think we are very fortunate in South Africa that our banking system escaped the whole global financial crisis and meltdown. There wasn't one South African bank that needed to be bailed out or that needed liquidity. And part of that was, I think, very good regulation from our central bank. Part of it was the National Credit Act, which was only promulgated towards, right towards the height of the crisis, but which we had been preparing for a long time. And I think what is happening in South Africa is that you have a steady increase in the level of unsecured lending. But if you're paying 25, 30, 32%, which is kind of the top end where microloans are charged at, and your loan gets bigger and bigger, you're going to end up in a debt trap. You will not be able to afford the repayments. And that's the risk that we're running now, is that people are consolidating perhaps a number of smaller loans into bigger and bigger loans, and in the consolidation process, extending the duration of the loan. So you now have a 200,000 loan for 5 years, and that kind of loan you cannot service. at the kind of average micro-lending or unsecured lending rates.
Here we are driving along in the beautiful Constantia Valley, off to the home of Iraj Abidi, and Iraj is one of the finest economists in this country. He used to be the group economist at Standard Bank. He was also a professor at the University of Cape Town. And we're off now to get his views on debt.
Iraj, let's talk about debt. Let's talk about the debt that you and I take on. Let's talk about the debt that corporations take on. And also let's talk about sovereign debt. They're all linked, aren't they?
Absolutely. All forms of debt within a given economy are interlinked and interconnected. Overall, debt assumes meaning as the economy grows, becomes richer, therefore it's able to sustain a higher level of indebtedness. For example, much like a corporation or much like a family, the higher your income, the more you can sustain higher levels of debt. But as the economy grows, gets richer, hopefully more diversified, and its income base becomes more predictable and sustainable, it can take on more debt to grow faster. But as it does, the question is how that debt is apportioned between various components within the economy. And broadly speaking, there are three components in any given economy at any point in time: the corporates, the households, and the government as an entity. Those three debts combined defines the max that an economy can leverage. 2007, the corporates were over indebted. Lehman Brothers went down because it had over leveraged. General Motors was running into difficulties as Northern Rock in the UK and many other banks and corporations who were over leveraged, and hence the so-called financial crisis. What happened at that time, which in my view constitutes a major political misjudgment. Of course, the left of the center would quite comfortably argue, and possibly convincingly argue, that the corporates managed to transfer their private debt or corporate debt into the books of the state. So suddenly the UK Treasury ran out of borrowing cap. Italian, the Spanish, the US, and so on and so forth, suddenly absorbed, or if you prefer, nationalized the debt of the corporate capitalist entities. The capitalists behind the scenes pulled and pushed every lever that they had available to them, and convinced the national treasuries that if the government does not come to the party, or if the government did not come to the party, there would be the so-called systemic risk. The systemic risk argument was the flavor of the day in August of 2008, 2007, 2008.
So we've established that debt is interlinked. It starts at the household level and then it expands to impact on corporates and financial institutions, eventually creating havoc in the world's economies, and then finally expanding and rippling into the financial crisis that is gripping most of the world at the moment. After the break, sovereign debt comes under our microscope.